the tariffs are on China and China alone, then the various estimates that are going around is that it could push inflation by as much as 0.3% for the US over the next 6 months to a year. However, if the tariffs are actually on the entire globe, then the inflation impact could be much more meaningful. It could be as much as 0.5 to 0.6% in the next calendar year and up to another 1 percentage point the following year.
In India, the latest GDP number was not that great, and unfortunately, the inflation number was also high. What's the path you see for interest rate?
If the rupee needs to be defended, then this expected rate cut can always get pushed down the road.
Inflation prints around the world have been volatile. How will that impact interest rates by central banks and consequently the debt market in 2025? To discuss this and more, I have with me Tanveer Sethi, Investment Manager for Fixed Income Strategies with Kotak Mahindra Asset Management Singapore Private Limited. Hi Tanveer, and let's talk about the Trump presidency. With Donald Trump coming into power, the die is rolling now on how interest rates in the US will move. What's your outlook?
Hi. So yes, this is a tricky one with Donald Trump coming in as the next president of the United States. And we know how ad hoc he can be, at least, if not in making decisions, in at least the way he tweets and the way he goes about doing his business. There could be a lot of increased volatility. And at the forefront is the big impending increase in tariffs that he's talking about. Now, will the tariffs be limited to just China or will they be on the rest of the globe? That is the big question. So before I move to this point on what these tariffs could mean, I'll take a step back. Firstly, let's look at where the US inflation has been. The inflation has consistently been slightly higher. It has been around the 2.7% year-on-year handle, and it's not yet reached the 2%, and that last mile has been the big challenge. Having said that, if we just look at the very last reading, we have seen an increase of roughly 0.3% in CPI, and if we look at the breakdown, if you look at between the various contributors, and we try to extrapolate the PC core inflation, which is the preferred gauge of the Fed, we expect that the PC inflation is around 0.17 to 0.18% for the last month, which means it has fallen significantly more than where it was in the past. It doesn't mean that inflation has been conquered. It just means it's a slightly better print than what we had seen for a few months. Now, coming back to what these tariffs could mean. Now, if the tariffs are on China and China alone, then the various estimates that are going around is that it could push inflation by as much as 0.3% for the US over the next 6 months to a year. However, if the tariffs are actually on the entire globe, then the inflation impact could be much more meaningful. It could be as much as 0.5 to 0.6% in the next calendar year and up to another 1 percentage point the following year. So it could really change the trajectory of inflation depending on what finally happens. So at this stage, I think we cannot act on what Trump will do or will not do. I think at the end of the day, he understands that inflation cannot shoot up and he would want inflation to be low as well. I think there will be a lot of threatening going on. There may be interim tariffs introduced as well, only to be rolled back once he's able to negotiate. We all know he's a very hard negotiator, and there may be a lot of tactics. And eventually, as of now, our base case is there won't be tariffs on the rest of the world. There might be some on China, but not on the rest of the world, which means that the increase in inflation should be manageable. So at this junction, with slightly easing inflation, the global growth will take a hit, specifically China, if there is Chinese tariffs. The growth looking to come down as well. We believe that Fed probably is on course to deliver at least 2 more rate cuts in the next 2 policy meetings, probably a third rate cut as well. And I think anything beyond that is too early to say now.
In India, the latest GDP number was not that great, and unfortunately, the inflation number was also high. What's the path you see for interest rates?
So, this is getting increasingly difficult, not only for us, of course, for RBI/MPC to decide, right? At one hand, you have inflation, which is continuing to be over their threshold of 6%. On the other hand, the growth has come down significantly. You decrease rates, you cut rates, you support the GDP, but on the other side, you run the risk of the currency weakening, and the currency has been weaker. So, and add to that, we have a change in governor, we have change in the other 3 MPC members, and there's a fair likelihood that even the deputy governor of RBI will change. So we may have as many as 5 members who have changed. But putting aside all these other factors, I think, and most of the market is getting positioned towards a policy rate cut in the Fed meeting. Clearly, the growth has been much softer than anticipated. It is looking to be soft as well. A little bit of boost can come up from increased capital expenditure by the government, which has been lagging. But nonetheless, the various other factors still do increase towards softer growth. And it does require an upliftment. So we do believe that 25 basis point rate cut followed by at least another 25 basis point rate cut in the following meeting is on the cards. But yes, we will also have to see that up to that event, how the US has reacted. We spoke about Trump. We'll have to see if Trump has come up with any new exceptional policies which impact emerging markets, which increase volatility in rupee. And if the rupee needs to be defended, then this expected rate cut can always get pushed down the road.
And finally, what's the outlook that you have for the debt market in 2025?
In the near term, to be honest, it's a little mixed. We still believe that eventually, although a shallow rate cut cycle, we do believe that RBI will deliver a 50 to 75 basis points kind of a rate cut over the next 2 to 3 quarters, which means rates will move down. Real interest rates are at reasonable highs, so that paves way. The RBI in its previous meeting has indicated they expect inflation to move towards 4.5% in the mid of 2025, which again paves way for eventually them cutting rates. So we do believe that rates are moving down over the next couple of quarters. So assets will perform. But on the other hand, there is the risk of currency depreciation. Also, as I mentioned, I think there's a fair chance that the rupee could depreciate another percentage to 2 percentage points from here over the next month or two. So I think it's a little bit of a mixed. If the rupee were to depreciate ahead of these rate cuts, I think that would be a fantastic opportunity for investors to invest. For investors who are looking at a more longer term, I think you could put aside the volatility in currency and invest into the longer term trend. But yes, it's not as bullish as I probably would have been a couple of months ago.
All right, Tanveer, many thanks for joining us today. Thank you, viewers, for tuning in. Wish you a very happy holidays.